Welcome everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance. As many of you are aware, the SBIA is the Advocacy Association for Investment Professionals focused on America's lower middle market companies. Our association has maintained a key role in promoting the growth and vitality of this industry and the small businesses it supports for more than 60 years. We're pleased to bring you our Lunch and Learn webinar series with today's topic, the COVID stimulus hangover and other economic issues facing portfolio companies. Our series of educational webinars is designed to provide valuable content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. If you have questions for our speakers during the presentation, please use the chat feature in your GoToWebinar menu bar. We will monitor this section and the panelists will address questions throughout the webinar. Also, please use this feature to let us know if you're having technical issues. Today's technical director, Ainsley Hoffman, will reply with suggestions. Please note that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded without approval by SBIA and the professionals at Polsinelli. Today's session is possible because of the support of our longtime silver sponsor, Polsinelli. Polsinelli is an AM Law 100 firm with more than 850 attorneys and 22 offices nationwide. Polsinelli's SBIC regulatory and finance practice is dedicated to helping SBICs navigate the full range of legal issues critical to their success. The Polsinelli team focuses on advising their SBIC clients in all business decision-making processes, from the point of formation and licensing to providing regulatory advice and leading their financing, investment, and related transactions. Today, we welcome Phil Fagan, who is a shareholder in Polsinelli's business department, a chair of the Financial Institutions Practice Group, and a managing partner of the firm's Washington, D.C. office. Phil focuses on representing financial institutions, small business investment companies, and other entities before the Small Business Administration, private investment funds, federal and state banks, and financial services companies. Joining Phil is Bill Sanders. Bill is a shareholder in Polsinelli's business department and a chair of the firm's tax practice group. Bill has broad tax experience in corporate, partnership, limited liability company, complex business transactions, and workout and bankruptcy issues. With clients ranging from Fortune 100 companies to family-owned and tax-exempt organizations, he regularly represents clients nationwide before the Internal Revenue Service at all levels and in court. Bill also assists clients in implementing tax advantage structures for all types of business transactions. And finally, we welcome Sarah Ainsworth. As an associate in the securities and corporate finance practice, Sarah works with Polsinelli's team of attorneys to analyze and develop a strategic approach to representation based on a client's immediate and long-term goals. Sarah helps deliver a range of legal services during the life cycle of the client's business, from selecting the appropriate choice of entity through exit strategy to assisting with the nuts and bolts of fund formation and fund transactions. Phil, it's my pleasure to welcome you and your colleagues today, and I'll turn the virtual podium over to you to provide a brief outline of today's discussion.
Great, thank you very much, and we're happy to be here today. And just want to say this is a good representation of the SBA, of the Polsinelli team, as you have Bill in Kansas City, Sarah in Dallas, and I'm coming from Washington, D.C. When we originally planned this program, we weren't sure where changes would have been in the CARES Act over the last few weeks. So I just want to say there are two bills currently pending, one in the Senate, one in the House. They don't match up, and it's not clear whether there'll be any changes between now and the election, and not clear whether there'll be another PPP program. So we'll just give you what we have based on what we know. And so what we're going to cover today is an update generally in the M&A process under companies that have PPP loans, some of the recent tax rulings. Then there's been some interesting information that's come out of the bank regulators and the SEC that we'll provide to you. Then on the fund side, Bill's going to cover some new rules regarding carried interest, payroll tax holiday, and if we have time, we'll talk about the Main Street lending program. So let's go ahead and start with what's going on in the PPP world. Basically, when there's an M&A transaction, and we're seeing this more and more lately, portfolio companies who have taken loans and now have entered into a transaction, or portfolio companies that are acquiring entities who have PPP loans. There's three things you really need to talk about, and I like to think of them in buckets, and the buckets don't necessarily interact with each other. So you need to think about where the party with the loan is with respect to their forgiveness. Then you separately need to think about, hey, what does the bank need to do if there's been a PPP loan and you're going to enter into a transaction, and account for the timing of how the bank's going to handle it. And then third, you need to look at whether it's something that the SEC needs to approve, the SBA needs to approve or not, and whether there's been guidance on whether they need to approve it. So we're going to take a closer look at all three of those. Sarah, you want to start?
Sure. So the first consent that we're going to discuss is lender consent. So depending on the promissory note or the loan agreement that the PPP borrower has, it's likely that an M&A transaction would result in an event of default. Usually the applicable provision, if they're using the SBA form, references reorganizations, mergers, consolidations, changes of ownership, or changes of structure. In most transactions, they will fall into one of the buckets that's listed in the promissory note. One thing that we have been noting is to be careful of cross defaults. So even if the PPP loan doesn't specify that this particular transaction would be an event of default, we have seen borrowers who have other loans with that lender, and it would be a default under that loan, and so would cause a cross default with the PPP. So that's something to really, bear in mind and double check each of those provisions in the promissory notes. We have seen different constructs on how lenders are giving consent. One of them is that they'll only give consent if the forgivable amount is escrowed until either the SBA consents to the transaction or forgiveness is obtained. Not every lender is requiring an escrow, but it is coming up more and more. Additionally, we have seen some lenders who are just not willing to fully waive the event of default unless they get affirmative SBA consent. And so it's just really important to have those conversations with the lender about waiving the event of default, discussing with the SBA, and figuring out a structure that works for both the borrower and the lender. And Phil's going to talk about getting SBA consent in these transactions.
Yeah, before I do that, Sarah, just one thing. In our experience, when you're going to the bank, how up to speed are they on all of these processes?
We've seen a really wide range of experience, particularly with obtaining SBA approval if necessary. It ranges from banks that are 7A lenders, outside of the PPP, and so are fairly comfortable with the processes and they have a good, robust relationship with the SBA. We have other lenders who were unaware that they needed to get SBA approval in the event of a change of ownership. So it really spans the gamut. And it's important to just make sure that everybody's on the same page when having those discussions with the lender.
Yeah, so moving into that topic, if SBA approval is required, it has to be done through the lender. You as the borrower, the portfolio company as the borrower, can't go directly to the SBA because the bank or the lender is in charge of the PPP loan. And it's a separate rule that's different from whether there has been a default on the loan through the loan documents. As part of the 7A program, and the PPP program falls under that, any change of ownership from somebody who borrowed money through the PPP program, which happens within 12 months of receiving your last payment on the PPP loan. So if you got a payment right at the time you got the loan, any change of ownership within the next 12 months requires SBA approval. It's not in the PPP rules. It's addressed in one FAQ that has come out, but it really is addressed through the SBA saying, hey, PPP loans are part of the 7A program, and as part of the 7A program, this approval for change of ownership is required. If you look at the approval, language, it says any change of ownership in little letters. So it doesn't define what a change of ownership is, and you need to be careful. It's not necessarily the same definition of what Sarah went through in the previous slide related to an event of default. So here's what we know, and it's still an ever-changing rule or process that the SBA is following. We know that if you're selling a majority of the equity, you got to go to the SBA and get approval. We know that they have said that they believe selling substantially all the assets, so even if you're not changing the equity of the company, amounts to a change of ownership. We have seen some rulings from the SBA that said if you're changing things at the parent of the borrower level, so you're selling the parent's assets or you're selling equity at the parent level, as long as nothing is being changed at the borrower level, you don't need change of ownership approval. Again, that doesn't mean it's not still an event of default under the bank documents. It just means that you don't need SBA approval. What is unclear to us is what is the number that triggers change of ownership when you need to get SBA approval. We don't know if that number is 10%. We don't know if that's 20%. The best thing to do that we can say is go to your bank, see what your bank says about contacting the SBA and getting them to talk about it with you. How do you do that? There's no specific application. The bank has to go to the SBA regional office. Technically, under the rules, the SBA regional office has 15 business days to either approve, not approve, or tell you they need more time. In our experience, they're not responding in 15 days or even telling you you need more time. We've been hearing 2 to 6 weeks that they'll respond with an answer. It's been, in our experience, in some cases more than 6 weeks. Again, it depends on the regional office for the bank that you borrowed, and it depends on how busy they are. But it's fair to have the bank ask them questions. There's no application process. You have to provide them information through email about the transaction, the relative transaction documents, and how employees are going to be affected before and after the transaction, and also why you chose at this point in time to do the transaction. So let's talk about the third element of the buckets, and Sarah's going to go over that.
So an important element of any of these transactions is when you time the closing. So if you time the closing during the covered period, and many borrowers have decided to extend their covered period into that 24-week period. So some borrowers are looking at a much longer covered period than the initial 8-week covered period. There is a concern that if you time the closing during the covered period, that you may see reductions in your forgiveness. And the reason why has all to do with employees and the ability of the borrower to continue to use the funds. So if the buyer is taking on a PPP loan, but not the employees, then there could be a reduction due to a reduced FTE count. So it's going to be very important for the buyer to look at the FTE count during the covered period with which the initial borrower had the loan, and then look at what the FTE count would be once the loan was assumed. Conversely, if the buyer is not taking the PPP loan but is taking the employees, then the borrower could face a reduction in forgiveness because they no longer have any employees, which creates another issue. If the borrower no longer has employees as a result of the transaction, but still has the PPP loan and still has, outstanding money to use, it's possible that they won't be able to use all of the loan proceeds, or that they won't be able to maintain that 60-40 split between payroll and non-payroll. We have seen a couple of different mitigation strategies for transactions that do close in the middle of covered period and would result in a reduction of the forgivable amount due to the employees. The first is a transition services agreement. So the employees would stay with the initial borrower and transfer over once the covered period has elapsed and once forgiveness has been applied for, so that the FTE count stays the same and there's no impact to forgiveness. Similarly, we've seen kind of an interim management agreement that would last until forgiveness is applied for, and once forgiveness has either been obtained or applied for, then the transaction would fully close. But it's really important to make sure that the timing of everything isn't going to result in a reduction in forgiveness or somehow jeopardize the ability of the borrower to get forgiveness.
Hey, Sarah, the one thing we also don't know with respect to these management agreements and transition agreements, I confirm that we haven't really seen the SBA and how they would tolerate that with respect to either the forgiveness aspect or whether that was deemed a change of ownership prior to SBA approval, correct?
That's correct. We really haven't seen how any of those two structures, whether it be the transition services agreement or the management agreement, would potentially impact forgiveness. I think, our assumption right now with the plain language of change of ownership would be, as the SBA has said in their previous rules related to equity ownership or a sale of all the assets, but this point has not been specifically addressed by the SBA.
Yeah, and the other point is, even if it doesn't trigger a change of ownership for SBA purposes, the transition service agreement or management agreement could be deemed an event of default by the SBA lender, by the bank. So it's important to make sure how the bank is going to handle it if you build that in as a solution to timing. So I think we skipped over. Oh no, sorry, we're on the next slide. So a little bit of practical tips here. Sellers and buyers should talk about this early. If you're the seller, you should be concerned because if the buyer finds out about it late in the process or through due diligence, it could impact the timing. So it's something you really should bring up at the beginning of a deal. Buyers should check for it early as part of their due diligence because they ought to know with it and deal with it. And even though it's the onus of the seller who may have a PPP loan to pay it back, everybody needs to understand both the economic impact of the transaction and who's going to deal with any residual effect that comes out of it. So it's really important. One of the things folks are doing in their M&A agreements is, because there's a 6-year audit window that could happen after the PPP loan was received, and people are using indemnification, kind of like you see with any other type of potential liability. If it's something that the borrower did, they should be responsible for it. If it's something that happens because of the transaction and it's something that the buyer did, they should be responsible for it. Other things that people are using as a device to deal with it is escrow agreements. To get the bank to sign off on the transaction, and then placing money in escrow to find out what the forgiveness is, or separately making an agreement, signing it subject to SBA regulatory approval, and not closing until you get SBA regulatory approval. Important thing to take away from this is talk about it up front and make sure there's a strategy on all three buckets that we talked about.
And just to follow on quickly about the due diligence, we have seen sellers kind of at the beginning of thinking about selling the business already do the due diligence for the PPP so that they already have that package available for potential buyers. So I'm going to discuss the audit risk. I think this has been pretty widely discussed, but just a reminder that the SBA will audit all PPP loans of over $2 million, and likely PPP loans in which an affiliate group has loans of more than $2 million. This audit risk is important because they can occur at any time in the 6 years following the end of the covered period. And so if a portfolio company is planning an exit, it's important to have all of those documents in place now. And the forgiveness application lists out all the documentation that's required to be maintained. And so we suggest having a file that contains everything from eligibility analysis, affiliation analysis, loan application, forgiveness application, all of the documentation that backs up the use of proceeds and the number of employees all in one place, so that, if 5 years down the line, there's an audit to determine whether the borrower was supposed to have a PPP loan, all that documentation is already in place and available.
Yeah, and the next slide, not too different than the audit risk. If you're doing a transaction and you have forgiveness built into the transaction and you might be closing while waiting for forgiveness, you need to address it in the documentations. You also need to address the fact that if there is forgiveness that happens after the transaction, there's an appeal process, and you're going to need the seller's help if they're the borrower in order to deal with the appeal process. So you need to make sure that they're locked up to help you with that and providing the documentation. So I think next we're going to turn to my buddy Bill Sanders. If you haven't heard him speak before, he's a tax attorney that actually can give a little levity to what he's saying, and he's going to go through some changes in that affect PPP loans and other CARES Act issues, and they're important. So, Bill, you want to go ahead and start?
Sure. Thanks, Phil. And depending on where you are in the country out there, good morning or good afternoon to all the participants. So the next part of the presentation is really going to be about the PPP loan forgiveness tax angle, as well as the other CARES Act tax matters and how we've seen those impact M&A transactions since the establishment of the CARES Act. So relative to loan forgiveness, we I think most people know that Congress was, on board here with trying to provide as much relief as possible to those that were impacted by COVID. And in the statute, in the CARES Act statute, provided specifically that debt forgiveness was not taxable income, which is contrary to what the prevailing law is, which is, unless there's an exception that applies, any debt forgiveness by a third party is typically taxable income. So they were forward-looking when it came to that. Unfortunately, the IRS, in its infinite wisdom, put out Notice 2020-32, which said, well, in their view, if the debt forgiveness is not income, then the what would be ordinarily deductible expenses associated with what the loan proceeds were used for aren't going to be deductible. So in other words, the payroll and all the other items that gave rise to the deductibility application in the first place. This was not taken well in Washington, D.C., and there have been a number of pieces of legislation which have drifted through the processes that would overturn this IRS position, which, by the way, is not necessarily one that's grounded in good in theory in terms of tax law. There's, we think, a number of challenges which are available to it, and there may be those challenges later on, but hopefully that won't be necessary. Hopefully Congress will get the ability to legislate over this. Until they do, the deductions are not going to be allowable, at least by the IRS, and the expectation is that they'll take that position in the event that there's any examination. We think that another round of stimulus, if it's going to occur and might have this provision, is likely to be, if at all, near the end of this month. There's an expectation, at least from what I've heard in our DC office, of a spike in COVID by virtue of schools getting back into session and Labor Day activities. If that happens, then there's a possibility. In terms of the denial of the deduction and the timing of that, the forgiveness in most cases won't occur until the next taxable year. And so there's a question as to how to deal with that, particularly if you filed a return already that takes the deduction because you don't know that the loan is going to be forgiven. And for a number of reasons, it may be really more beneficial to take the denial of deductions in a subsequent tax year. For example, because of the CARES Act NOL provisions, there's the ability perhaps to generate an NOL in 2020, carry that back, and get dollars back if you're a C Corp, for example, at a much higher rate. Back then, the 5-year carryback rule, which came about by virtue of the CARES Act, allows you to go back into years where the tax rate for C Corps was at a higher rate. So it may be beneficial to actually take that denial of deduction in a later year as opposed to in the year that the loan is granted, the loan was received. And one theory, at least in terms of being able to take that position, is the annual accounting tax principle, which basically says at the end of a tax year, you determine where you are, and that's how you file your return. At the end of the tax year, if you don't know that the loan is going to be forgiven, then you don't deny the deductions in that year. It's the next year. So let's quickly go through some other CARES Act tax considerations and then how we're dealing with those from an M&A perspective. So just remembering back to the provisions that were applicable back then and are still being taken by a variety of taxpayers. The employer retention payroll tax credit, which was a credit that was allowable up to $5,000 per employee, even for large companies, for payments that are made to employees when they weren't working. And the last part of that is really the critical part. We've seen some very aggressive positions taken by companies relative to time not working. If you got employees that are on time clock, for example, that's pretty easy to substantiate, but otherwise it's become a very, what we think will be a highly scrutinized area by the IRS. The other ones that were prominent in the CARES Act were the employer share Social Security deferral, which allowed from the date of enactment until December 31st, all employer share of Social Security to be deferred, 50% due 12/31 of 2021, the other 50% due 12/31 of 2022, and then the NOL revisions that I mentioned just a few moments ago that allow any losses in 18, 19, or 20 to be carried back 5 years. And before the CARES Act, carrybacks had been disallowed by the 2017 Tax Act. So relative to these particular items, in terms of due diligence that we've seen necessary in transactions, M&A transactions, is relative to the loan forgiveness, absent, you can move to the next slide now, absent a legislative fix. You need to confirm that the expenses that have given rise to the loan forgiveness either haven't been deducted, or if they have, that there's provision made for post M&A recognition and that the tax consequence associated with that. As I mentioned a while ago, the employer retention tax credit is one we think has had a tremendous amount of aggressive behavior out there. So being very careful about records relative to that, and reps and warranties associated with that to be very, very tight. Confirming the amount of Social Security that's been deferred and making sure that that's accounted for as a liability on the balance sheet. And then once again, with respect to the NOLs, making sure that you take advantage of them if you can, or if they've been taken advantage of, to take that into account in terms of the transaction. One other item from a due diligence perspective that I'll talk about at the end of the presentation is essentially the payroll holiday part 2, which is the employee share of Social Security, which recently was the subject of a presidential executive order, and then we got additional somewhat guidance this last Friday. So I'll talk about that a little later, but that's another tax item to deal with in terms of M&A transactions. Okay, that's all I have with respect to the CARES Act and the tax matters, and so now I'll hand it back over to Phil with respect to regulatory changes.
Sure. So we're going to get back to Bill in a moment because he's got some really cool updates on carried interest that I think fund managers are going to want to hear, and the stuff on the payroll holidays. Before we do the regulatory changes, a question came in regarding PPP loans, and the need for bank and SBA approval if the borrower is a portfolio company or an operating company, took out the loan, and the change of ownership is at the holdco level. Do you need bank or SBA consent? So on the SBA side, we have seen them come back with emails saying you don't need to do that if nothing has changed at the borrower level. They still have the same employees, they still have the same ability to service their debt if they don't get forgiveness, and all you're doing is changing out owners of the holdco. Can't necessarily rely on that at this point. None of what the SBA regional offices are saying, but I will pass along that we've seen them take that position in certain of the regional offices. With respect to whether you need bank consent, under most PPP loan documents, a reorganization is considered a event of default. I think always under bank documents, it's best to ask the bank and let them know, because notification is the easiest. It is possible that you need a waiver at the bank level, but you don't need SBA consent. So that's the best guidance we can give there. A couple of regulatory changes we want to talk about real quickly. One relates to changes in the Volcker rule that we'll just mention, and that affects funds. And the other one relates to accredited investors and qualified investors, which really affect portfolio companies and what you may see in their doing offerings in the near future. So under the Volcker rule, for years, SBICs have not been considered covered funds and therefore have been exempt from the Volcker rule. And the problem is when they get to their end of their life, and a lot of them want to give up their license, the only reason they're holding on to the SBIC license is so they can continue to have that exclusion from the Volcker rule. Otherwise, they'd be real happy to give it back just because of the cost. And this is at the very end of the fund when they're winding down. Volcker rule has been changed, with the help of the SBIA, so that if they're in a wind down mode and you get back your license, you'll be able to still be excluded from being a covered fund. That goes into effect October 1st. Sarah, you want to talk about some of the changes to the credit investor rule and qualified investor real quickly?
Sure. So the SEC expanded the definition of accredited investors to include the following individuals or entities. Mainly these include individuals who have certain personal certifications or relationship with a fund. It also expands to include any entity, including LLCs, that have assets of more than $5 million and were not formed for the specific purpose of investing securities offered. Interestingly, it's also included couples who are in a spousal equivalent relationship, and so if they were married, would otherwise be considered accredited investors. There also was a change to the definition of qualified institutional buyers. So LLCs and RBICs were included into the definition of qualified institutional buyers. It also created a new 144A rule to allow certain institutions that are accredited investors to qualify as qualified institutional buyers when they satisfy the $100 million in securities owned and invested. So now Bill is going to talk about carried interest.
Thanks, Sarah. And the reason why we're discussing that today is there's been, as I think most people know, recent development in the area. On July 31st, proposed regulations were issued, very lengthy and complex, in some cases somewhat controversial, in other cases confirming what the Code Section 1061 indicated and filled in some of the gaps. So I'm going to briefly go over kind of where the land is at this point in time relative to the interaction of the code section as well as the proposed legislation. This first slide just talks a bit about the history, and I always get a kick out of that first point because I can remember back in 2007 when I think it was a Wall Street Journal article laid out what I thought was an inappropriate way to talk about this area, but it got a lot of traction throughout the media and then in DC, where fund managers, these rich fund managers were making all kinds of money, were paying less of a marginal tax rate than the janitors that were cleaning their buildings. It took 10 years for there to be any substance from this, although there was lots of rhetoric for many years, lots of proposed legislation, but it just couldn't get any traction until, ironically, the Tax Cuts and Jobs Act added 1061, which provided for, instead of a 1-year hold for long-term capital gains, a 3-year hold under certain circumstances. And those circumstances were the defined term of carried interest under 1061. Finally, it's almost 3 years later, we've got proposed regulations relative to that code section. And the interesting thing about proposed regulations is they typically are not applicable to transactions until after they become final. That having been said, that's usually not the approach the government takes. They take the position that this is what the law is going to be, and so we're going to apply this consistent with what the law is going to be at some point in time. Courts don't give it that kind of credibility, but they do look at it as guidance. So it is important to know what's in there and the potential impact. Interestingly, and I'll mention this in more detail in just a few minutes, the part relative to putting a carried interest in an S corp and the government saying that doesn't work, with respect to the proposed regs, that piece of it is the only piece which would have retroactive applicability. Once the regs become final, they're saying that applies as of the enactment date of 1061. So they're very hot on that. You'll see at the bottom of this slide the items that we're going to cover that were the basic outline of the proposed regulations. So just going to what is a partnership interest that's subject to the rule as changed by or modified by the proposed regulations. In general, it's partnership interest that's transferred in connection with the performance of substantial services, which is basically any services. It's referred to now as an API, and it applies regardless of how many tiers you have that are in place. Obviously, that would have been an easy way to circumvent the rule if you could tier partnerships and change the characterization. The tiers are essentially ignored relative to a characterization. Let's look quickly at the API exceptions. Those are ones where it's not an applicable partnership interest because of a specific exception that's built into the code and once again in the proposed regs, which is on the next slide. Those are, and the big one is the corporate exception. So any partnership interests that are held by corporations are by definition not APIs. And interestingly, throughout much of the code and regulations, the reference to corporations includes S corporations. In fact, in most places, the code is set up where you have this body of law that applies to all corporations, and then you have this subset that applies only to S corps, and it kind of overlays C corps. Despite that fact, the IRS came out and said in Notice 2018-18 that they don't think an S corp is a corp for purposes of this particular provision, and they're going to not allow the exception in the case of S corporations. The proposed regs, as I mentioned a moment ago, confirm this fact. There's likely to be some pushback relative to this and challenge, I would suspect, at some point in time. But suffice it to say, the government's position is the S corp doesn't work. So you can't take your interest in the fund, the GP interest, and put it into an S corp and then not have this rule apply, at least not in the IRS's views. Other exceptions, capital interests in partnerships, so the right to share in partnership profits commensurate with your capital contribution. So to the extent that a GP has, required capital contribution, any allocations associated with that capital interest, this rule does not apply, which makes sense, right? And so the other exceptions are interests held by employees of certain other entities, and then partnership interests that are acquired by purchase of fair market value by non-service partners. So quickly, what are the businesses that are subject to the API rule? So once again, an API is not subject to Section 1061 unless it's transferred in connection with the performance of services for a business that is subject to 1061. What are those businesses? Well, those businesses are ones that are pass two tests. Basically, the first test is they're raising or returning capital, typical for most funds, whether it be an SBIC or otherwise. And then number two, either investing in or developing certain types of assets. And those assets you'll see are in the second bullet below. They're securities, commodities, real estate, partnership interests, options, warrants, those kind of things. So in a typical situation where a fund would invest in a portfolio company, if it's debt, it's not going to apply. The carried interest rule is not going to apply that. But rarely do you have long-term capital gain that's generated by virtue of holding debt. On the other hand, any equity interests that are held in those portfolio companies are in general going to be subject to this rule. So general applicability with respect to that. And just noteworthy is that the investing or developing or the raising or the returning of capital don't have to happen in the same years. They can be in different years, or they can be prospective relative to the activities of the fund. Okay, how do you calculate the recharacterized gain? In other words, what would be under normal rules a long-term capital gain is recharacterized as a short-term capital gain, and how does that operate? So the general rule, and this is where we got some clarity from the proposed regulations, which is it's determined by the seller. Whoever is selling the asset, that's the holding period you look at. So if it's the holder of the carried interest and they sell the carried interest, it's how long they've owned that carried interest. If the portfolio company is selling assets and then that flows up to the fund, it's the holding period for those assets that the portfolio company has. If the fund is selling the interest that it has in the portfolio company itself, then it's that holding period that dictates whether or not it's recharacterized. So the 3-year rule, once again, applies to whoever the seller is at that point in time. And as I mentioned before, tiered in terms of tiers, once you get a character at some point by virtue of whoever is selling the asset, it continues to keep that same characterization going upstream. Another big exception is 1231. So 1231 says to the extent that you hold an asset for a year or more, and that asset is either a depreciable asset or it's real estate and it's used in a trade or business, then the rules for 1061 don't apply. So you can have a holding period of just 1 year for these assets, or 2 years, anything less than 3 years, the rule still doesn't apply. So in this case, it provides some flexibility if you have the opportunity to have a portfolio company sell its assets, as long as it's held them for a year or more. Any gain on depreciable property, which generally speaking isn't going to be a ton because that's usually not where the built-in gain is, or in real estate, which may apply in certain circumstances. If they're 1231 assets, the rule doesn't apply. Another good thing to remember here is that if the portfolio company is selling the asset, and let's assume that for whatever reason the fund hasn't held the interest in the portfolio company for 3 years or more, but the sale is of assets and the company's been around for more than 3 years, then the goodwill that is associated with the sale, generally speaking, would be more than 3 years. And so the sale of that goodwill would meet the 3-year requirement, and therefore upstream, it would be considered to be long-term capital gain for everyone. So flexibility in terms of being able to determine who is the seller is helpful to try to to deal with the rules that are at hand. Okay, the next slide has to do with transfers of partnership interests to related parties. Very detailed. I'm not going to go through all the rules here. Just suffice it to say that if there's a transfer to a related party or a consideration for a transfer to a related party, which by the way is related in the normal sense or to one of the other service providers that has received a carried interest, there's going to be taxation in most cases, even if it's a non-taxable event in normal tax verbiage. For example, if it's a gift, there still could be gain recognition by virtue of that transfer. Any accretion associated with assets that are held by the fund or downstream less than 3 years could be triggered. So be very careful if there's a transfer of a carried interest to any related party, irrespective of whether it's for consideration or not. The next slide talks about reporting requirements. Once again, I'm not going to go into detail with respect to these because it's not really information that's relevant to this group, but suffice it to say that the tax return preparers are going to be in a position where they're going to be asking a lot of questions associated with carried interests that are held by funds, because they're need to report that in a fashion which provides the IRS notice and the opportunity to know who to audit and who to examine is one which will require additional information on these forms. So it'll make the reporting a bit more complicated and complex for the accountants that are associated with most funds. Okay, that's all I have with respect to carried interest. I'm sure there'll be a lot more fallout in the near term. Once again, these proposed regs are only 30 days old. There will be some commenting on those before they become final, and so the additional information will be available on thoughts out there about how they apply to specific situations. The last thing that I'd like to go through before we move to Main Street funding is a very recent tax matter, and it's been referred to as Payroll Holiday Part 2. And if you remember, the first payroll holiday that I mentioned earlier in the presentation has to do with a Social Security employer share deferral. So the Social Security that the employer has to match on all of its employees from the date of enactment of the CARES Act through December 31st has been deferred until the end of 21 and the end of 22. By virtue of an executive order by President Trump, actually it was in the form of a memorandum, on August 8th, the order was to defer employees' share of Social Security for employees who have an annual salary of $104,000 or less, and that deferral would be for any payrolls that began yesterday and ended on or before December 31st, 2020. So it's not when you provided the service, but it's when the payroll is. So any payrolls that happened yesterday technically are part of this executive order. Lots of unknowns by virtue of this executive order, and we were hoping that we would get significant guidance. We were promised it before September 1st. It came last Friday, and it really only answered two things. Number one, when does it have to be repaid? And number two, who's responsible in all likelihood if it doesn't get repaid? So if you go to the next slide, you'll see, based upon the dilemmas here, there's really three options on how to deal with this. The first option is to comply with the executive order, which typically is what you would want to do. Presidential orders not followed have typically been something that are met with some consequences. In this particular case, it seems that not following it is one of the options. I'll go through that in a minute. But the first option, as I mentioned, is to follow the order. And if you do that, really there's two issues associated with that. The first is that really the best thing to do for your rank and file employees? Because this new guidance that we got last Friday said it has to be repaid ratably between January 1st and April 30th. So it's really only a 4-month deferral. And for all these folks that are used to living from paycheck to paycheck, if you will, getting a little bit more money between September and December might be a good thing, particularly for Christmas. But then having to pay it back between January and April is probably a very bad idea, especially that being right after Christmas. The essential fallout of this is during that period of time, you're paying 12.4%. These employees will be paying 12.4% to Social Security as opposed to the 6.2. So query whether that's really a good thing. The other thing to think about is that to the extent that this is complied with, and let's say an employee leaves, is fired or just leaves the employment, during that time period, it's become clear that the employer is going to be responsible for that. Lots of suggestions on how to deal with that, employment law issues all over the place and trying to get it back from the employee. So real concern about the potential liability of employers there. The third option is just do nothing and act like this executive order is not out there, status quo. I think lots of people are going to do that. In fact, we've seen that most that are faced with this are going to continue to do what they've done previously. And the only potential bad consequence of that would be if, in fact, there is some kind of legislative forgiveness at some point to repay this before January 1st. If that happens, then you may have employees who feel like they've lost out on the opportunity to have a little more in their paycheck. The second option was to withhold and hold it and wait and see if that legislative forgiveness occurred. At this point, though, there's a footnote in the guidance that was issued last Friday, which would suggest that's a bad idea, because the footnote suggests that you should, anytime you withhold, you have the obligation to deposit. So if you withhold and don't pay over, you're potentially subject to penalties for failing to deposit in a timely fashion. We don't know if we're going to get any more guidance. We're hoping that we will. The thing that's made the number 3 option really viable is Secretary Munchin in public comments he made about 2 weeks ago indicated that applying this is really optional. So number 3 is, as I said, what most people are from what we can tell, most employers are taking that route. So that's all I have relative to the payroll holidays. And Phil, if we have time, feel free to go through the Main Street Lending Program.
Sarah's going to do that in about 30 seconds or less.
Just quick update on Main Street Lending. As of August 19th, $500 million of the loans made and accepted. We've seen that borrowers and lenders are discouraged from originating these loans to fund other debt payments. We also note that they issued a release about the safe harbor. So the SBA's ineligible business definition would have excluded borrowers that are owned by Main Street Lending Program lender or its affiliates. There's now a 5% safe harbor. So for those borrowers that are owned 5% or less, they are now eligible for the program as well.
Great. Thanks, Sarah. And thanks, Bill, for all of your practical, insightful advice. And we want to thank all of you for participating. You can contact any one of us about these issues we discussed today. If it's tax, please contact Bill. For the other areas, best is to email Sarah and I, and one of us will get back to you, but you can always call either one of us as well. Thank you very much.
Thank you very much. This was a terrific discussion, and we appreciate the time and expertise that you have so graciously shared with us today. Now that we're all back to work this fall, SBIA's Fall Lunch and Learn webinar series will continue throughout September, October, and November. Our next Lunch and Learn webinar is scheduled for Tuesday, September 15th, with a session about managing credit in a downturn. We hope that you'll join us. A replay of today's discussion, along with the presentation materials, will be distributed to SBIA members and will also be available on the SBIA website at sbia.org. You may review our previous presentations and materials on the website as well. If you're not an SBIA member and would like to learn more about joining our organization, please contact my colleague, Alex Frick, at 202-628-5055 or email membership@sbia.org. Thank you again, and we look forward to having you join us soon.